Hi there, it's Dan Kurz, DK Analytics. Thanks a lot for tuning in. It is February 14th, 2020, and after a multi-month absence, I'm chiming back in. This video's contents will revolve around the following: U.S. jobs, U.S. debt, global financial repression, and the coronavirus. Before I delve in, let me go to some valuation metrics. The trade-weighted U.S. dollar stood, according to the Federal Reserve, at 90.82, still hanging high, but showing a bit of weakening. I'm always reminded by Keynes' famous saying, markets can stay rational longer than you can stay solvent. I'll leave it at that, and hopefully what I'm going to address will give some substance to the fact that should be an ending valuation. That is, the dollar is bound to go lower. The U.S. 10-year, the Treasury, it's been in rally mode. Global fears of weakening economic growth, political uncertainty, the coronavirus implications. People are going to a so-called safe harbor. They're diving into U.S. Treasuries and other investment grade, so-called investment grade long bonds, government bonds rather. I think it's a mistake because I think at current yields, you don't have any margin of safety. You have negative returns if you take a real world inflation rate, and you have huge downside risk if, when interest rates turn back in the other direction. Moreover, you have untold solvency and monetary inflation risks. So I think bonds are the biggest bubble, but I'm repeating myself. Closely behind stocks, the S&P 500, it's gone from on one record to the other for the first 6 weeks of this new year, is ignoring the headwind, the concerns, the EPS slowdowns and worse, and keeps on rallying. As I've said multiple times, stocks and bonds are attached at the interest rate / discount hip, but at turning points, inflection points, when economies crater, shareholders take it on the chin, and there should be a parting of ways. But instead, they're both celebrating. So one of the two is wrong. Frankly, I think they both are. I think they should both be heading down, but that's an old song. Oil, 52.17 per blue barrel. Oil's been under pressure, dropped from the 60s, low 60s, into I think the high 40s, is pulled back into the low 50s. Here too, global economic weakening concerns, momentary imbalance of oil, too much supply. But I think in strategic terms, that's going to be replaced by the tightening supply, the joke that fracking is, and that's going in reverse. And moreover, it'll be a good inflation play, but I'm getting ahead of myself. And, oh, yes, lastly, nothing goes in today's leveraged economic output, however feeble it's become in terms of improving productivity, without fossil fuels, starting with oil, sister natural gas, and of course, all important, but panned coal. Gold, meanwhile, has caught a bid, has been moving up. That's the real safe harbor asset, and it recently traded. These valuations are early this morning, these prices, at $1,578 per troy ounce. Silver hasn't really been along for the ride. Silver recently traded spot price at $17.67 per troy ounce. The silver to gold ratio has widened in the direction of 90, so silver isn't getting the traction that gold is, yet it comes out of the ground at roughly 9-to-1 to gold, but is not valued accordingly. So you have silver to gold at 90-to-1 almost, and silver comes out of the ground at only 9-to-1 gold. There's some other aspects, including energy, but I think there's huge upward potential for both of these precious metals, physical form, and silver even much more so, as I have gone into. Let me address some housekeeping issues. First, again, pardon my 2-month absence. I wasn't sipping cocktails in a sun-drenched hammock. I published 2 posts in January. I've gotten back into some publishing because I've managed to take out another 70% out of my site costs, or 75. The first post in very early January was titled, "Is Today's America Democracy, a Republic, or Something Else?" And the second one, around mid-month, was, "How did the price of silver fare in the stagflationary 70s and then some?" I encourage you to glance at these posts if you haven't had a chance. I think they'll complement my remarks here. Related to those posts, a confession. Numerous incremental improvements to the posts took place after publishing, although both the content and the message of both posts remained unchanged. I grew up Catholic. I also had some logistical challenges since my last video in mid-December. The solution to one involved a quick 1,500-mile car trip north to upstate New York and 1,500 miles back from upstate New York to Southwest Florida. More germane to this channel, I've continued to think about how to broaden the appeal of this micro channel without diluting the content. I have also reached out to knowledgeable people that I respect for their suggestions. My conclusion: shorter but still beefy and hopefully relevant videos is worth a go. This is the first iteration, the first attempt in the right direction. Please cut me some slack as I whittle down the minutes from up to an hour or 50 minutes in the direction of half an hour, and then hopefully substantially south from there. Let me now jump into the topics. Again, I mentioned that I wanted to talk about U.S. jobs, U.S. debt, global financial repression, and the coronavirus. U.S. jobs. I'm going to argue that they're not, what they're cracked up to be, nor up to President Trump's hype. Let me add before continuing that I voted for Trump in 2016, and I will definitely vote for him if given the chance in November 2020, this year. Everybody on the other side is just indescribably worse. So I think there is no choice. It's a binary choice. Here go the job numbers. That is some reality checks. On the heels of at first glance, very robust 225,000 American payroll growth number for January 2020, I have the following additions or addendums or remarks that throw some cold water on this and related things on this front called jobs, American jobs. Manufacturing employment in January fell by 12,000, having fallen for either 2 of the last 3 months or 3 of the last 4. I don't rightly recall for sure. That decline for the last 2 out of 3 or 3 out of 4 months is not exactly indicative of a manufacturing revival, manufacturing employment down, much less indicative of increases of high value added, high paying jobs, something which our expanded net trade deficit, goods and services, under Trump over his first 3 years in office also show. That is, our net trade deficit under Trump, his first 3 years, is bigger than Obama's net trade deficit was, or under his administration during his last 3 years in office, which confirms what I'm telling you about manufacturing jobs not being that robust, all right? Specifically, an aggregate $1.75 trillion net trade deficit under Trump, first 3 years, compares with Obama's last 3 years, $1.46 trillion trade deficit. So we've actually got growth in a trade deficit during Trump's tenure, which does not exactly suggest that manufacturing is back. Plus, we've seen massive downside payroll employment benchmark revisions that just recently surfaced, which took down the reported annual job growth number between January 16 and January 20, last month, by a whopping 20%. And payroll jobs were just revised down by 514,000 using the March 2019 benchmark, or based off of that benchmark. Furthermore, retail employment was also revised sharply lower, plunging for 32 consecutive months. In a nutshell, and this is really where it's at, private sector, non-farm payroll growth of 6.8 million during Trump's first 3 years in office is less than Obama's 7.4 million payroll growth number, private sector, non-farm, during his last 3 years in office. So Trump's 6.8 million is less than Obama's 7.4 million non-farm private sector payroll growth. And then, just a few days ago, to add another dimension to the jobs, or the job front isn't so great as advertised. Just a few days ago, U.S. job openings were down 15% month over month in December, which has become a multi-month trend of job openings deterioration prior to the coronavirus outbreak. And moreover, this recent sharp decline over the last few months has constituted the sharpest reduction in job openings since prior to the onset of the 2008 recession. Let me see if I can bring this onto the camera here. Here we go. All right, that's this. Okay, this is the sharp deceleration in job openings, and it's reminiscent of this. Will this continue to head south like this did? That's the question. But no doubt there's substantial pressure here in new job openings. Let me now show that non-farm U.S. payroll growth as a percent of total non-farm payrolls over decades, all right? And this to show you, to give you a sense of how increasingly relatively weak new payroll growth compared to payrolls, all people employed, has become, especially as of the turn of the century, the new millennium, and very much extending into the teens, the decade we just ended, no matter how much money has been printed or thrown at it. Let me see if I can bring this on screen as well, or onto the camera rather. And again, this is US, okay? This is US payroll growth compared to total payrolls. And whoops, there we go. What you'll see here is a marked, long-standing, multi-decade deceleration. And then as of 2000, we have gone way below 2% payroll growth compared to all employed or payroll numbers, and have never really come up for air since. That is, it's been sustainably weak, including out of the chute in the 08 recession, the big recession. It never really returned to vigor or strength. And this is important because it tells a big story about GDP growth, right? Which I'm going to get into, and you can surmise if growth in employment is continuously less robust, then by golly, you're going to have weaker GDP growth as well because income, personal income, isn't going to be as strong. Right? Just common sense stuff. To put this into the following picture of how that 225,000 payroll number looks, or relative to the much expanded overall labor force, and I'll get into that in a second as well. That 225,000 January payroll expansion number prior to likely downward revisions isn't what it was in the 80s or 90s. Why? Because, as I said, the labor force and the population were significantly small. Translation: less income growth to fuel consumption in a consumption function economy, an economy where, according to the Fed, consumption comprises over 68% of GDP. Staying on the jobs front, let me now take a look at the U.S. labor force participation rate to further drive home my jobs point. And the labor force participation rate is those that are employed plus those still actively looking for employment compared to the entire labor force. And as you might be able to imagine or probably know, it also has been heading south for a host of reasons. Aging is certainly one of them. Here we go. Here's again the high water mark in 2000. We got up into the 67% plus category for about a decade and a half. And then into the new century, millennium, we've been heading south, south, south. So in essence, we've gone from a 67+% labor force participation rate way down in the last 20 years and have basically bottomed out, it appears, at about 63%, right? So going from 67 plus to 63 plus is a large decline. And it has very substantial impact, again, on national income growth and, by extension, economic growth. Let me drill down on the declining labor force participation rate in the U.S. And this is a concern given aging societies that goes on throughout OECD world to varying degrees. But it casts a big shadow on future economic growth and productivity and things like that, and financeability. When I drill down, let me start to give you a sense of the bigger framework, starting with the U.S. population. According to the U.S. Census Bureau, the U.S. population in early 2000 was 281 million people. The labor force participation rate back then was the mentioned 67% plus. It stood at 67.3% in early 00. Again, the ratio consists of employed and those looking for work divided by the size of the labor force. On February 10th of this year, a few days ago, the U.S. population, again according to the U.S. Census Bureau, was 329 million, a whopping 48 million person increase in 20 years, 48 million. In contrast, the most recent labor force participation rate, as I indicated on this chart, was into the 63 range. Specifically, the latest tally was 63.4, I believe, in January of this year of 2020, which is nearly 4 percentage points lower than 20 years ago. The upshot here is that a lower percentage of working age populations is either in the workforce or looking for jobs, which is pressuring national income growth, itself the theoretical equivalent of GDP growth, right? Meanwhile, the working age population, according to the U.S. Bureau of Labor Statistics, was 178 million in 2000, January 2000, and 206 million as of December 2019, the latest tally on record. This is a 28 million person increase in the U.S. in its working age population over nearly 20 years, compared to a 48 million person growth in the overall population. So the overall population increased by 48 million people, and the working age population only increased by 28 million people. Given that most of the U.S.'s population growth came courtesy of south of the border immigration, and most of that illegal, and their children, that is, the births of their children in the United States, this loosely suggests, given where our population growth in the U.S. has been from, that only 58% of third world immigrants were of working age. Again, our population growth is almost exclusively immigration based. If that is the case, and 58% of the third world immigrants were by extrapolation working age, that is the 58% of 48 million growth in population, then you can guess what a substantial portion of the other 42% of the southern border immigrants did. They availed themselves of welfare, quote unquote, at the U.S. taxpayer, or in my case, Floridian taxpayers' expense. Certainly most illuminative. Back in early 2000, private sector employment in the U.S. was 115 million. The most recent tally as of January 2020, 130 million. This means that the ranks of those employed in the private sector, which pays for public sector jobs and for welfare, redistributionism, if you will, increased by only 15 million in nearly 20 years, while the American population over the same time span expanded by 48 million. The takeaway? The U.S. population over the past 2 decades expanded 3.2 times as fast as the private sector workforce, amidst increasingly underfunded public and private pension plans, increasingly underfunded Social Security, increasingly underfunded Medicare, and increasingly underfunded veterans benefits, which collectively have multi-trillion-dollar funding shortfalls. If one assigns a net present value to all the unfunded public sector promises or obligations, a number of between $100 trillion and $210 trillion pops up, or between 5 and 10 times annual U.S. economic output. With rising old age dependency ratios, more people retired compared to working, huge plan underfunding in both private and public realms, a declining labor force participation rate, a sustained shift away from high-paying full-time private sector jobs with benefits to, generally speaking, poorly paying part-time service sector jobs without benefits, the only way for households to sustain their financially unsustainable path is to keep piling debt onto debt. That is, to sustain something that their income can't. And, by the way, note that even the government's utterly misleading and understated median CPI ran at an annual rate of 3.7% in January. Try doubling or tripling that to get a real-world inflation rate, and the plight of consumers becomes even clearer, of job takers becomes even clearer. Speaking of debt, household debt continues to rise, having reached a record $14.2 trillion in Q4 of last year, according to the New York Fed. And that this last quarter, Q4 19, was the 22nd consecutive quarterly increase, with total household debt now $1.5 trillion higher in nominal terms, of course, than the pre-recession peak of $12.7 trillion set in the third quarter of 2008. And this is despite mortgage debt, by the way, still nominally trailing the Q3 2008 $10 trillion high watermark, in sympathy with substantially lower home ownership rates since then, to this day. Therefore, non-housing debt, led by auto and student loans that are increasingly moving into the non-performing loan category, has increased by slightly over $1.5 trillion since Q3 of 08, accounting for more than 100% of the increase in total household debt. Given the quickly declining value of cars and the increasingly dubious value of super expensive student indoctrination in labor markets offering less high-paying private sector jobs, one could say that the quality of household debt, from a creditor's perspective, has gone south. The bottom line in all this, despite all the greatest economy ever, featuring the best job market ever boasts and claims, continued weak private sector job growth and poor new job compensation / benefits have forced many Americans into multiple jobs, into two-income households, and into ever more debt to make up the difference. This is not a recipe for sustainable growth, sustainable economic growth. Rather, it is a confirmation of just how precarious future economic growth and EPS growth are. I'll dive into the corporate aspect of that in a different video. Perhaps the most recent GDP tally, 1.2% real economic growth in Q4 19. And don't forget, if we used a real inflation number, we'd have negative real GDP growth, okay? But this 1.2% real growth tally, taking it for the moment at face value, is indicative of where we're going, I think. Perhaps 2019's real GDP growth will be revised down substantially in sympathy with sharply ebbing manufacturing and mining / drilling activity and much weaker than thought payroll growth, especially in the private sector, the only productive sector. New government jobs, which have been more robust, only tie the economy up in yet more bureaucratic knots while hurting the Main Street makers that pay government workers outsized salaries and gold-plated benefits, in the process pouring cold water on private sector wealth creation, their ability to invest in growth and people, and ultimately in private sector job growth. It's a vicious circle. Perhaps the $1.3 trillion increase in federal debt over the past year to February 10, 2020, it's on the Treasury's site to the last penny, you can see for yourself. Perhaps this increase, coupled with the rising household debt, are the true pillars underpinning our increasingly anemic economic growth. Perhaps they are the true engines of poor quality, growth-induced, growth-increasing economic growth during Trump's term, or more, quote, Obama socialism, unquote, falsely dressed up in free market capitalist clothes. For more flavor, listen to Trump's February 4th State of the Union speech. Now, I don't want to take away from the good parts, and on the Constitution, but fiscally and monetarily, it's a disaster, in my opinion. In any case, if you listen to it, you will find that he talks about more welfare and warfare spending left and right, record federal government spending, and a string of trillion-dollar Trump-era deficits notwithstanding. They can be damned. Even Trump's recently released proposal for nibbling at the spending edges doesn't touch the elephants in the room. Hugely bloated entitlement spending and hugely bloated military spending. His proposal is a true budget discipline red herring, if there ever was one. Disingenuous at best, and utterly wasted opportunity at worst. About as far removed as possible from his campaign pledge to get rid of government debt, not even deficits, debt, within 8 years. Moreover, Santa Trump, with the federal government already $23 trillion in debt, Main Street taxpayers and creditors alike funding parental leave for government workers, and Trump looking to bankroll a new bureaucracy called the Space Force, even as out in space federal deficits of well over $1 trillion are brushed aside, and America's overseas financing needs of nearly $600 billion per annum and its net foreign debtor status of nearly $11 trillion are apparently viewed as trivial or insignificant. Not to worry. All the while, Trump keeps insisting that the Fed keep cranking up its electronic printing press to even stouter levels while driving Fed-controlled interest rates into negative territory. Even faster dollar debasement for the world's biggest debtor nation, requiring massive annual foreign financing? How long will creditors keep their heads in the sand? Perhaps as domestic and global economies get progressively weaker, creaking and groaning under a decade plus of financial repression, we will get even more financial cocaine. Our global financial repression has been typified by over $15 trillion in central bank balance sheet expansion and widespread zero and negative interest rate policies for over a decade. Collectively, our Frankenstein finance has fueled an $80 trillion global debt expansion, more entrenched cronyism, larger government deficits, corporate anorexia, the de facto LBOing of the S&P 500, and redistribution and misallocations and malinvestments and the resulting collapse in productivity growth, not to mention yield starvation for savers and pension funds alike. Do you really think that those same central banksters will now keep from doubling down on yet more yield starvation and more central bank bond and stock purchases to try to stay high in their golden saddle? Frankly, given the extreme nature of the counterfeit currency power addiction, this is as likely as night following day. Of course they'll print more money. Of course they'll keep lowering rates wherever they can. Said differently, and I quote, "Permit me to issue and control the money of a nation, and I care not who makes its laws." And just perhaps, the straw that breaks the global economy's back and pushes it deeply into recession is spelled corona, as in the virus, which could trigger not only a human tragedy, but a full-blown global recession thanks to the manufacturing, commerce, and trade restrictive responses to this virus that are spreading from ground zero China throughout the rest of the world. Of course, such economic activity dampening responses will surely serve as a trigger to usher in yet more aggressive money printing and yield deprivation from China, already happening, to the rest of Asia, to Europe, to America, and likely beyond. Now, relatively recent history suggests that virus contagion or pandemic fears are usually misplaced, that is, they are contained. Plus, we nearly always fail to recognize what will prove to be the pin that pops our valuation insanity bubble. We're usually surprised. It typically comes out of left field. And the coronavirus is, at this point, no longer out of left field. But given the unparalleled fragility of our over-indebted, misallocated global economy, which is at the tail end of a historically weak but extremely long expansion cycle featuring feeble U.S. consumer purchasing power, massive debt, and massive malinvestments, it wouldn't take much, whatever form the surprise does take, to turn confidence in counterfeit currency and the assets priced therein and in abused Keynesianism into stockholder fear and flight. So from confidence in counterfeit currency, assets expressed in those currencies, and totally abused Keynesianism, we might have a very sudden shift in sentiment and confidence, namely to stockholder fear and flight. Overlay this dynamic onto crumbling growth, stagnating EPS increasingly under pressure. I'll devote a video just to that, a brief one, and insane stock and bond valuations, and the capital at risk or the value at risk in those two asset classes, stocks and bonds, becomes pretty clear. And the same holds true for real estate that hasn't gotten clipped, because this asset class is also very tied into overvalued bonds, that is, historically low yields / discount rates. All this, of course, remains a strategic reallocation opportunity away from overvalued assets to undervalued assets for those that bought these assets at very dear prices. That strategic reallocation opportunity can quickly become tactical, or do it now, and then urgent, and quickly too late, given how fast corrections occur, which today's ETF-based investing, today's indexing, today's massive derivatives exposure, and today's computerized trading promise to make faster and steeper in terms of our corrections than ever before. A reallocation opportunity, in short, from overvalued stocks and bonds purchased at lofty valuations into attractively valued, vital, tangible assets in the dense energy and food arenas. You've got to eat. Without dense energy, fossil fuels, our output implodes. And there are not even going to be any earnings, much less much in the way of sales, all right? So these are going to be vital, real asset categories that also, given their relative and absolute scarcity, will do well as we move into a stagflationary environment, something I went over in the latest Silver Post. A reallocation opportunity also from overvalued stocks and bonds and select real estate into secure cash / T-bills in the U.S., where you can't be bailed in. You've got global bail-in legislation on the books. And if you have your money in bank accounts. And in an asset, T-bills or short-term treasuries in other nations, where they can print the governments, the central banks, the money to pay you. And lastly, where there is no duration / spiking interest rate risk, like a 10-year or 30-year. What happens to that bond when rates go from 1 or 2 to 7 or 8? It just gets eviscerated. You're talking over 50% reductions in the value of those bonds. And then you're locked in at a low interest rate, right? That's the trap. A reallocation opportunity also from, again, overvalued stocks and bonds and select real estate into real money and into true safe haven assets, namely physical precious metals held outside of the banking system, preferably in reach. Assets which have long been manipulated lower by those controlling what constitutes today's fiat money. I hope you found my video worthy of thought. I'm going to tune out here and wish you a happy Valentine's Day. Bye-bye.